Okay, hello everyone. Welcome to the Budget and Tax Overview. My name is Mandy Rafel and I'm the Director of NCSL's Fiscal Affairs Program, and I'm going to be your host here today during our session. And I thought it would be fun to, before we begin, take a quick survey of the audience and see how you rate your understanding of the budget and tax processes that we're going to be discussing here today. So I have a quick poll question. So go ahead and hit the poll tab, poll number 1. And the question is, which movie title best describes your understanding of the federal and state budget process? And your options are Lost in Translation, Dazed and Confused, Pan's Labyrinth, As Good as It Gets, and Educated. So go ahead and take a minute to vote. Okay, votes are coming in. Okay, so it looks like we've got equal parts Dazed and Confused and Educated. So you're in the right place because we're going to have a high level overview, but we'll also get into some details of current activity. So that should appeal to both levels of understanding. Oh, now we have more Dazed and Confused. Okay, well, that's good because we are going to shed some light on all of this. But before we do that, I just want to point out a couple of key features of this platform. You'll see 2 tabs that say chat and Q&A. Chat function is informal and allows you to interact with each other. So you're welcome to go ahead and introduce yourself in the chat function if you like. And then the Q&A is if you have a question for any of our speakers at any time. Go ahead and write a question in there. And then if you see a question from someone else that you like, you have the opportunity to upvote it by using the up arrow. And then lastly, if at any time you need technical help, just use the help button at the bottom of the page. And I know many of you are new to policymaking and to NCSL. So I just want to give you a quick rundown of the Fiscal Affairs Program. I mean, our main purpose at NCSL is to help you all do your jobs better. And one of the ways we do that is by providing information. And we conduct research and provide expertise on a number of fiscal issues, including budget and taxes. And while that's one of our core areas, we also cover economic development, tax incentives, gaming, tourism, financial services, and much more. And you can find all of our fiscal program work on the NCSL website under the Fiscal Policy tab. So it's now my pleasure to introduce 3 of my NCSL colleagues. First up is Erlinda Doherty, and Erlinda covers federal budget and tax issues. And she's going to give us a high-level overview of how the federal budget process works. And then after Erlinda, we'll hear from Erica McKellar and Jackson Brainerd. Erica covers state budget issues for NCSL, and Jackson follows state taxes. And all 3 of them are super knowledgeable, and they will be available at the conclusion of all the presentations to answer any questions that you have. And again, just put those in the Q&A. And so at this point, I will just turn it over to Erlinda, and she can kick off the presentation.
Wonderful. Thank you so much. I'm just going to share my screen here. Welcome, everyone. Thank you so much, Mandy, for that lovely introduction. As Mandy mentioned, we work in concert are here in the DC office with our friends and colleagues in the fiscal office in Denver. I am the director of the Budgets and Revenue Committee in our Washington, DC office. I'm going to give you all an overview of the federal budget process, as well as an update on COVID relief to states, which I know is of huge interest to everyone at this moment. So again, this is the Budgets and Revenue Committee in Washington, DC, and we examine all the federal and state policies with fiscal implications. You can see the list of items here, all of them having to deal with, of course, tax, budget appropriations, also with unfunded mandates, down to state and local fiscal relations. We represent the 50 states before DC on these fiscal issues, advocating before Congress and the administration for those items of interest to you, as well as communicate and collaborate with other like-minded organizations, advocacy organizations, and think tanks. All right, so as we start here, a little bit of a breakdown of how we're going to structure this presentation, starting with what is a federal budget, the steps of the budget, what budget control mechanisms exist, and then finally with a wrap up with the COVID-19 relief efforts that have been happening since this pandemic began almost a year ago, and then an update on where we are with the most latest round of federal relief that's being worked on in Congress right now. So what is the federal budget? Well, it's not just a spreadsheet of pluses and minuses. It really is a enumeration of the goals, priorities, and values that the federal government has. Trade-offs and challenges for putting the government on a sustainable path while also trying to stabilize debt, which we'll talk about in a minute here too. We call it policy alphabet soup, and it really is the spending plan for government, which was enacted into policy or into law with the Congressional Budget Act of 1974. So what are the steps? So step number one is in theory, this is all theory, of course, and we'll get into why it doesn't really happen this way a lot, but in theory, the first process in the budget process, or the first step, I should say, is the president's budget request. It officially kicks off the budget. Normally it's submitted by the first Monday in February. This year, it still hasn't been submitted yet because President Biden has been focused on his COVID relief package. So there's still some discussion as to when he's actually going to officially, present his budget. Last year, President Trump submitted his budget a month late. So, this has been a floating sort of a target, I guess, for a few years now. It is the recommendation for the president's overall vision for his federal fiscal policy. And it puts across, or he or she explains in this document how much to spend on public purposes, how much the plan is to take in on revenues, and how much of a debt or deficit the government should run. And just as an FYI, the latest deficit update that we have is that for the first quarter of FY21, which began in October, $572.9 billion, which is up 61% from a year earlier. And this is again all kind of reflecting the massive amounts of stimulus that the government has injected into the economy. So again, it's a remuneration of the president's policies and priorities, what specific programs are important to him or her relative to other programs. And there's basically two pots of money on how, or two categories of funds that are put into this program. We have our discretionary funds, which are programs that are annually appropriated under the jurisdiction of the House and Senate Appropriations Committees. And these are funds that have to actually, or programs that have to actually be discretionary, that have to be going through this process, versus what we call mandatory or entitlement programs, which are mostly tax code and federal spending that's been set, and things that are paid automatically. And that actually takes up a large chunk of the government, the budget. You actually see the actual discretionary slice of the money pie is less than a third. And here's an example of FY 2019. You can see that mandatory spending is truly the lion's share of the dollars, discretionary only taking about a third, and the largest pot or piece of discretionary funding is the defense budget. So number two, what is the second step theoretically in the budget process? It's called the Congressional Budget Resolution. Basically, Congress develops its own budget plan. House and Senate budget committees have hearings from all the different agencies. It does not enact the spending law, but actually sets the targets for Congress themselves. Very broad, 19 budget functions, and there's basically it sets the limits and the authority for the cash outflow. And normally, or in theory, this budget resolution is supposed to be passed by April 15th, but surprise, hasn't happened for a while now. Hardly ever met, as you can see, and if there isn't a budget resolution that's actually passed, Congress has the ability to deem, or that's sort of an informal resolution, if you will, verbally, that basically will set the overall standards or the spending measures, plans for Congress. And basically, with the ending of the Bipartisan Budget Act, which had established statutory budgets in 2-year increments, that more or less took the place of a budget resolution. Okay, so then we're into actually enacting the budget legislation. And there's two options, and the second one we'll talk a little bit more about too, because it's being discussed quite frequently now. But option one we call slow and steady. It's the regular annual appropriations process where both chambers times 12 committees equals 24 spending bills that each of the committees are supposed to pass individually. Discretionary spending is constrained to the amounts that were laid out in the actual budget resolution, if there was in fact one. And CBO, the Congressional Budget Office, must score or give their analysis as to what these bills would actually cost. Option two, which has gotten a lot of press lately and has been resurrected more or less, is what we call the budget reconciliation process. And it's used on occasion to expedite spending bill consideration. What it does is it requires a simple majority as opposed to a 2/3 majority. And what happens is both the House and Senate have to approve basically identical packages, and then the bill gets presented with an up or down vote. All right, so if a budget doesn't get passed in time by the end of the fiscal year, well, what happens? And we've become very familiar with this, sadly. Government shutdown, unless Congress has decided to pass a continuing resolution, which basically funds the government at the levels of the previous fiscal year's levels. And we've had several occasions, sadly, again, of these government shutdowns with, I've listed the top three here, 35 days during the Trump administration. We had 16 days during Obama's administration and 21 days. So we've become very familiar with, again, sadly, with this kind of overarching, looming, destabilizing government shutdown process. And this every year basically calls into question the validity and the utility of the current budget process that we have, because as I mentioned, it is not, in theory, these are the steps, but every year it doesn't, in reality does not follow what was put into place. And here again is an example of 2019 spending. 2020 numbers are still being figured out, but this is exactly what you can see here. And again, the discretionary piece is really only truly a smaller piece of the overall mandatory spending. So what budget control mechanisms are there? How do we keep budgets from going off the rails? Well, there's a few, and one called PAYGO, which again was talked about a little bit earlier on for the Senate, basically, which requires for every outlay, that another either a spending cut or a revenue increase to make up for that. So trying to achieve some sort of balance here. And again, the federal government doesn't have the requirements that state governments do to actually have balanced budgets. So this is why there are these control mechanisms are here in existence. Then we have caps, sequestration, and relief that are also mechanisms that Congress can use to rein in some of the spending and make cuts and revenue increases in other ways. And again, this is theory versus reality, right? So this whole process in general, we've got these steps that are laid out that was enacted by the Congressional Budget Act in 1974, but rarely does our budget process ever truly follow this pattern. And of course, this brings into question, or not in question, but it kind of transitions over into what the federal government has already done with respect to COVID-19 federal legislation, which is the biggest piece that Congress is dealing with right now, has basically taken priority over the regular appropriations process, of course, because we're undergoing this massive pandemic. But so far, the federal government has given the states and citizens $3.4 trillion in what I like to call 4 rounds of federal funding. Of course, the first round was when the pandemic first started in early March, and that was more so of emergency supplemental appropriations. Round 2 was the FFCRA, so the Families First Coronavirus Response Act, which really put into play a lot of the programs that we're relying upon now. The biggest was the CARES Act, which of course was important for states with the establishing of the CRF, the Coronavirus Relief Fund. In April, we passed round 3.5, which replenished the Paycheck Protection Program. And then the most recent was the COVID-19 Relief and Omnibus Appropriations Act, where basically Congress not only funded the government but also gave the last tranche of COVID-19 relief in one big bill. And again, here's sort of a summary of all the relief legislation that Congress has passed. Again, this whole pandemic has basically upended the normal appropriations process again, which is why this whole notion of what is the federal budget, what is budget process, is being discussed again to see its validity in the future and how we may need to reform it. This is the excuse me, President Biden's most recent proposal and what is being currently discussed right now. So as I mentioned, the last big relief tranche was passed before the new year. And this is the next big step that's being discussed right now is President Biden's proposal that's being now taken up by various committees and actually put into actual legislation to be taken up and discussed. And it's $1.9 trillion with the various priorities you can see here, with the most, I think, relevant right now is a $350 billion for states and localities that is also being discussed right now. And here is the latest update on that. So the House and Senate have already approved, as I mentioned before, this budget resolution to help fast track the elements of President Biden's $1.9 trillion measure. The House committees of jurisdiction this week are marking up the individual elements of the proposal, and you can see I've listed here the different committees of jurisdiction over various pieces of the president's plan. Again, of most interest to us is the $350 billion for state and local aid. And of course, I've listed all the other important pieces of his proposal that the various committees are taking up. And the House leadership expects to have all these components passed by the week of February 22nd in order to prevent a lot of the programs that are currently available now, the unemployment insurance, especially, to lapse before the mid-March deadline. Okay, and that concludes my presentation. Of course, any questions, feel free to reach out, or we'll have some Q&A at the end. And with that, I will turn it over to my colleague, Erica McKellar.
Thank you so much, Erlinda. And Mandy, I believe, is going to share some slides. And while she works on that, thanks, Erlinda, for that great federal overview. And good afternoon, everyone, and thanks for being with us today. As Erlinda and Mandy mentioned, I'm Erica McKellar, and I am in the Denver office of NCSL. And I primarily track state budget conditions and work on state budget process issues for NCSL. And I'm going to talk a little bit about both today. And I'm going to start off talking a little bit about the budget process. And I really love talking about the budget process because it's something, that we don't really talk about often. We tend to kind of get siloed in our state and recognize, really get an in-depth knowledge of the way our state particularly budgets. But I think it's always helpful to remember that no two states budget the same way. There are really 50 state ways to budget. And, it's something, but the budget process tends not to change a lot. There's a lot of tradition and history that goes into it. But the times that states do tend to kind of revisit the way they might be budgeting are usually after an economic downturn. So I think it's a good and exciting time to kind of be revisiting this issue. So just to kind of kick things off, I would just want to review sort of the timing of most state budgets. Typically, agencies submit budget requests to the governor's office in the fall. And then the governor kind of chooses his priorities, puts together his budget, and submits it to the legislature in January. From February to May, depending on the length of sessions, we know legislative session lengths varies greatly. Legislatures will hold budget hearings. I'm sure many of you are knee deep in that process right now. And then sometime between March and June, the legislature usually adopts that enacted budget. As I mentioned, session length varies by state. So this can happen anytime between March and July 1st, but that June 30th at midnight is really the kind of final time for states to be able to pass their budget. The new fiscal year begins on July 1st in all but 4 states: Alabama, Michigan, Texas, and New York. And I'll talk a little bit about what happens if states don't pass their budget on time in a little bit. So most states meet annually and pass a budget every year, but there are 15 states that meet annually but pass a budget every 2 years, and 4 states that pass a budget every 2 years, and the legislature also only meets every 2 years. Whether it's better to have an annual or a biennial budget is, a topic that comes up from time to time. It doesn't change often, but some states have changed over the years. But in practice, it doesn't really matter that much. The argument for a biennial budget is usually that, states spend a lot of time passing their budget. It's usually the main thing that a legislature has to do every session. And, in practice, I guess the argument is that it takes a lot of time and it takes a lot of attention of lawmakers. And if you budget every 2 years, the idea is that you might have more time in those off years to deal with other legislative issues, other policy and priority issues. In practice, though, a lot of biennial budgeting states almost act as annual budgeting states. Instead of enacting a true 2-year budget, they'll enact 2 one-year budgets at one time. They'll often be amending those budgets in the off years or passing supplemental budgets. And on the flip side, states that pass an annual budget sometimes present 2-year budget information to legislatures. So in practice, there's not a lot of difference. It's mostly important to just kind of have those good practices in place and a tradition and culture that works for your state. A lot of states also kind of mix the two. They might pass 2-year budgets for small agencies and then annual budgets for larger agencies. So no right or wrong way, but again, just an interesting look at the different way that states budget. Next slide, please, Mandy. Okay. So one of the most fundamental parts of state budgeting is figuring out how much the state has available to spend. We know that this has been a real challenge for states over the last year. We've never experienced the type of economic downturn that we saw at the start of last year. And it's really been a challenge for states to figure out how to revenue estimate in this kind of new world. But typically, there are a few different ways that states produce a revenue forecast. Mandy, sorry, can you go back a couple of slides? Thanks. There are a few different ways that states can produce their revenue estimate. The first is to have the executive branch produce a revenue estimate. The second is having a consensus revenue forecast, and that usually involves representatives from the executive branch, the legislative branch, and then a lot of times kind of some outside economists. The third way are sort of kind of some alternative ways that states might budget. Some states will have a university or other outside economists prepare their forecast. And then, sometimes states will have sort of competing forecasts. They'll have 2 different groups do it. So in Montana, for example, the executive branch and the legislative branch prepare estimates, and then the legislature gets to choose which forecast they're going to follow as they review the budget. When states officially revise their forecasts also varies by state. Some states only do it once a year at the start of legislative session. Other states do it quarterly. Some states have informal revisions every month or 2. So, that varies again greatly by state. You're probably going to get tired of hearing me say it varies by state, but there really are no 2 ways that states budget the same. The meaning of the forecast also varies by state. In some states, the forecast is more of a guideline. And in other states, it's really a hard and fast number that the governor or the legislature cannot go above. And it can be binding on the budget that states pass. So some differences in what the revenue estimate means for states as well. Next slide, please, Mandy. Okay, so it's Friday afternoon. To keep everybody kind of on their toes, I kind of want to do a quick trivia question here. If you feel like it, I'd like you to just kind of guess in the chat box how many states you think have a balanced budget requirement. And give you just a second to do that. All right. Well, if you guessed 49, you're right. Every state except Vermont has a balanced budget requirement, but it's almost a trick question because Vermont always does balance its budget by tradition. But I think balanced budget requirements are really important because one of the reasons revenue estimating is so important is that unlike the federal government that Arlinda mentioned, states can't run deficits. They have to follow these balanced budget requirements. Balanced budget requirements usually only apply to a state's general fund rather than kind of the total state budget, which gives states a little bit of flexibility. There are a handful of states that have education trust funds in addition to their general funds that are applicable, but things like bonds and some special funds are sometimes outside of those requirements. The stringency of requirements varies. It depends a lot on the language in the states. For example, at what point in the process does the budget have to be balanced? Does the governor have to propose a balanced budget, or does the legislature have to enact a balanced budget? And in some states, a deficit can be carried forward to be resolved in the next fiscal year. So there's a lot of academic discussions around the language and what it really means to have a balanced budget requirement. But I think the most important thing is that in practice, states balance their budget as a matter of history and tradition and culture. And it's something that I think is very important in the state budget process. So, similar to some of the other things we've talked about, what the appropriation bill means is also different in states. Throughout this presentation, I've been referring to the state's operating budget for the most part, but there are 18 states that roll every agency, every program, every line item into one omnibus appropriations bill. In Colorado, we creatively here call it the long bill. But there are 32 states that have multiple appropriations bills. Many times these are general fund or operating budget, capital budget, and then sometimes states will also break out a transportation budget. And there are a few states that will have multiple budget bills, and like every agency or a group of agencies will be rolled together into a budget bill. Fun fact, Arkansas has the most appropriation bills of any state. Each agency gets funded separately, and they have over 500 budget bills. So a lot of time and effort goes into that, I'm sure. Next slide, please, Mandy. So who controls the budget process? In every state, only the legislature can appropriate funds. It's one of the fundamental powers of the legislative institution. In practice, what that means can vary. In practice, in most states, the budget conversation is largely driven by that governor's proposed budget. But that's not true in every state. There are 6 states, Arizona, Colorado, New Mexico, Oklahoma, Mississippi, and Texas, that actually draft a budget independent of the governor's budget. So those states we tend to think of as having the most control, the legislature having the most control over their budget in the states. But as we mentioned, most legislatures are part-time. So once the legislature has enacted the budget, the governor signs it into law, and the session is over, everybody goes home. Who has control of it then during the interim? Governors have the authority in most states in the interim to transfer funds between programs within their agencies. And in some states, they can transfer funds between different agencies. Usually there are some controls on that threshold, a monetary threshold of how much they can transfer. And in a few cases, the governor can authorize additional funding without legislative approval. But again, that usually has a threshold control on it. In a majority of states, the governor has the authority to withhold funds from agencies. As a cost-saving measure, we saw a lot of governors put spending freezes in place during the start of the pandemic as states were trying to get a handle on what the fiscal impact would be of the pandemic on their economies. And governors largely have the authority to spend unanticipated federal funds without legislative approval. And I'll talk a little bit more about what that means in just a minute. The ability of legislatures, I think, to have more control over budgets during the interim is really kind of hindered by the part-time nature of most state legislators. There's quite broad authority for governors during those interim times. So unanticipated federal fund, most legislatures have the authority to appropriate anticipated federal funds. So Medicaid matches, other grants that states expect to receive, legislatures largely have control over those funds. But things get really messy when it comes to these unanticipated federal funds. We've seen that kind of play out with ERA a few years ago. We saw it with the CARES Act last year, and I anticipate we'll see it again if the proposal that Erlinda mentioned passes. It gets, sorry, could you go back a second, Mindy? I just want to mention that, unanticipated federal funds sounds like it would be one big category, but a lot of questions have sort of arisen over what type of funds these really are. Are they kind of regular unanticipated federal funds? Are they disaster funds? So we've seen like the individual language in states around these unanticipated funds has really played a role in who has had the authority to appropriate them. And we've seen courts have to weigh in a few cases. And I think, we've seen some legislatures introduce measures this legislative session to kind of try to get more control over those funds, especially in the interim. So something that I think we're going to continue to see playing out as more federal stimulus might come down the pipeline. Now you can go, Mandy. Thanks. So the last budget process issue that I kind of want to touch on is what happens if a state doesn't pass its budget by that June 30th, July 1st deadline. And again, of course, it depends. There are a lot of states that have actually never been in this situation. They've always passed their budget on time. It just hasn't come up. It's never been tested. So they don't really know exactly what would happen. In over 20 states, the government would shut down, at least in part. A lot of payments might be continuous, either in state law or from some state court rulings. Public safety employees tend to be sort of exempted from those. 12 states can pass continuing resolutions or temporary spending plans. We actually saw a lot of states do that during the pandemic last year, as legislatures kind of suspended their operations and tried to get a handle on how much revenue they were going to have. They implemented a temporary budget and decided to come back in the fall. So we saw that as a tool that states used during the pandemic. 3 states, North Carolina, Rhode Island, and Wisconsin, have provisions in place that will automatically continue funding at last year's appropriation levels if a budget's not in place by the start of the fiscal year. And just to kind of come back to that government shutdown piece a little bit, because I think it's always very dramatic when it happens, but in reality, it really doesn't happen that often. And when it does, it doesn't usually last very long. And I think one of the biggest reasons for that is the July 1st deadline that most states face. Most people are getting ready to go on their July 4th holidays, and people get upset when, they can't go visit their state parks and do some of the other kind of recreation and things that would fall under those government shutdowns. So they don't happen a lot. They just kind of are a little dramatic when they do happen. So I want to spend just a few minutes talking about state budget conditions around the country. I know most of you are probably working on your budgets now, so I think it's kind of helpful to see where state budget conditions are. At the start of all this, we really saw some catastrophic revenue estimates. A lot of states were preparing for cuts of 5 to 25% of their general funds. A lot of states freezing spending and dipping into their rainy day funds. And we at NCSL try to kind of keep tabs and keep track on how fiscal conditions are progressing in the states throughout the year. And as part of that, we survey legislative fiscal offices 2 or 3 times a year and ask them how the major tax categories are performing, how their overall revenues are performing, issues that they anticipate coming up in their legislatures. And we currently have a survey in the field right now where we're getting tabs on that. We have 35 state surveys back and a survey from Washington, D.C. So I just kind of want to go through some of the preliminary results of what we're seeing. And largely, hopefully it's good news and upbeat for everyone, because things are looking a lot better than we expected at the start of the pandemic. I'll caution, that it's all relative. I mentioned those kind of catastrophic estimates at the start, but I think it's still very good news. So the personal income taxes and general sales taxes make up the largest portion of state revenues in most states. And Jackson will talk more about state tax structures in a little bit. But we ask how those major tax categories are performing relative to their latest estimates. So you can see pretty good results here, above estimate in 13 states, on target in 15 states. And only one state right now reporting that they do not anticipate personal income tax collections coming in where they expected. So largely really good news on that front. You'll probably notice that these don't actually add up to 36. There'll be one or two off. The reasons for that are we know which states don't levy these major taxes. So even if we haven't received their survey response back, we're able to add that in. And a couple of times states don't have enough information to say how their revenues are performing. And usually that has to do with the timing of when they estimate their revenues. So just a little caveat there. All right. General sales and use tax collections, the second largest state tax category, also performing really well. 14 states above estimate, 14 states on target, only a couple expected to be below. So, I think really good news that we're seeing these come in on target, and we'll talk a couple minutes about the reasons for that in just a minute. Overall, at the end of the fiscal year, most states right now are expecting to meet that forecast or exceed that forecast. So good news. Again, this is relative to some of those pre-pandemic, or excuse me, those pandemic estimates, but generally good news. So the reason that taxes are performing better than expected, it varies across the states, but some of the reasons are that federal stimulus really did play a major role in helping states kind of weather this storm. There's a lot of evidence that the aid allowed states to kind of move some of their general funds around to different priority areas, specifically the FMAP, this federal government increased the matching amount that they were giving states for Medicaid. That really kind of helped shore up state Medicaid budgets and allow states to kind of move some of those general funds around. So that's one major reason. Additionally, states didn't see heavy job losses from some of these higher income tax brackets that tend to make up the bulk of the personal income tax collections. Those jobs were largely able to move to a remote working scenario. So states, that helped state revenues quite a bit. We largely didn't see consumers, quit spending as sectors kind of shut down. We saw them shift a lot to online sales purchases, purchasing of home goods. I think everybody's redoing their house right now, that type of thing. So those online sales taxes and that shifting consumer spending definitely helped states. And then lastly, the stock market has stayed largely strong. So all of this has combined to keep state revenues, kind of afloat during the pandemic. In our survey, we also asked legislative fiscal offices what they expect to be the top fiscal issues for the upcoming legislative session and into the future. And again, of course, this varies based on individual state needs. But some of the issues that kind of rose to the top this year, education funding was a very big one. In some cases, it was referenced more as just reviewing the funding formula, but in quite a few, it was also sort of restoring any cuts to education that may have been made at the start of the pandemic. Unsurprisingly, Medicaid and healthcare are still big areas of concern for states. Unemployment trust funds are a big issue. Over 20 states are already borrowing from the federal government for those programs. And 23 states use CARES Act money to help shore up those accounts. So something that I think we'll continue to see states grapple with. Then finally, just kind of concern that this influx of federal aid is really, there's a difference between recurring revenues and one-time revenues for states. And this is really kind of a big one-time influx of cash for states. And depending on the trajectory of the recovery and what we expect to see down the road in terms of federal aid, there's a concern that as those programs run out, states will either have to cut spending or replace that money with general fund spending. I think the proposal that Erlinda laid out will go a long way to alleviate those fears. Definitely something that legislative fiscal offices are thinking of. And then finally, I'll just kind of wrap up by saying that there's a lot of cautious optimism, I think, out there. Things from a state revenue perspective, at least, are looking a lot better than we expected, but there is still a lot of kind of uncertainty and concern. we don't know how quickly the vaccine rollout will happen. We don't know when travel will recover. Obviously there is unevenness and disparity in the economic recovery. So, things are looking better than we anticipated, but there's still a lot of uncertainty about what the future will hold. And I will stop there and let Jackson take over and tell you more about tax structures.
Great, thank you, Erica. And hello to everyone tuning in. Thanks for hopping on a Friday afternoon. Got some exciting material on state tax structures to go over here, so you can really kick your weekends off with a bang. But first, we're going to start with a quick trivia round to set the tone with some state tax 101 tidbits. These are going to be the last two polls on your screens. Got the fun polling feature, might as well use it. How many states, to start, tax the sale of Netflix subscriptions? I'll give you a few seconds to make your selection. Okay, time's up. The answer is only half, 25 states. Maybe surprising depending on your familiarity with sales tax issues. Next question, how many states have an estate or inheritance tax? Taxes imposed when a deceased person transfers money or property to a beneficiary. Give you another few seconds. Okay, time's up. The answer here is 18, well, 17 in DC technically. Next slide, please, Mandy. So the world of state tax can be pretty complex, and that is due in part to the fact that, as our trivia questions suggest, every state tax system is unique, just like their budgeting processes. The economic strengths, resource endowments, and demographic compositions of each state varies, and these are factors that quality revenue systems should take into account. There are some significant similarities, though. In general, states tend to rely on three primary tax sources. These are known as the big three in only the coolest tax policy circles. These are the personal income tax, sales, and corporate income tax. Most states levy all of these, but 9 don't have a personal income tax, 5 do not have a sales tax, and 6 do not levy corporate income tax. Next slide, please, Mandy. The largest portion of state tax collections comes from the personal income tax, followed closely by sales and use. Those are far and away the two largest tax categories. So it's really the big two and their little brother. Corporate income tax is a much smaller slice, around 5%. Then you have selective sales taxes. That includes all of the excise taxes that are levied on specific goods and services, motor fuel, tobacco, alcohol, cannabis, amusement taxes, etc. The miscellaneous tax category includes things like severance taxes on oil and gas or coal mining, estate taxes, licensing taxes. And then some people might be surprised that the property tax represents such a small slice of the state revenue pie. It is the single largest state and local tax source, but it is primarily a local revenue pool, although some states do levy narrow property taxes on things like utilities. And then not pictured in this pie graphic are charges and fees or federal transfers to states, which are probably the most important supporter of state fiscal health, as they account for about a third of total state revenue. Next slide. So this illustrates how states can vary in terms of their reliance on their taxes. Special economic circumstances or policy decisions have led some states to develop revenue systems that do not rely on a broad range of revenue sources. States with extensive mineral resources or unique tourist attractions can rely on more narrowly based tax systems. Alaska, for example, doesn't have a personal income tax or a sales tax and generates a significant majority of its revenue from severance taxes on oil and gas. South Dakota has no income tax and is therefore very reliant on sales and excise taxes. And then Oregon has no sales tax, so it leans heavily on the personal income tax. Next slide, please. This map here comes from the Pew Charitable Trusts, which recently put out a report that measured revenue volatility across states from fiscal years 2000 to 2019. Most states rely on a balanced variety of tax sources because it can help ensure stability in their collections. And we've seen how important budget stability can be for states over the last year or so. All taxes fluctuate with the economy, but historically speaking, the sales tax is the most stable, followed by the personal income tax, which is a bit more susceptible to fluctuations in the stock market. Severance taxes and corporate income taxes are reliably the most volatile. Of course, this does not always hold. Many states, the sales tax was hit particularly hard due to the economic impacts of COVID. You can go ahead to the next slide. When it comes to income taxes, the rates are often a major point of emphasis. Should marginal rates be increased on higher earners who can presumably bear a larger tax burden? Should rates be cut to try to stimulate economic growth and make the tax climate more desirable for businesses? In recent months, we saw a couple states, New Jersey, Arizona, increase taxes on higher earners. There are also governors in several states that are emphasizing income tax cuts to provide relief. For states considering cuts, a growing trend in the years leading up to the pandemic involves states enacting tax changes contingent on certain variables. So if a state, say, enacted a reduction from 6% to 5.5%, that only happens if the state meets a certain revenue threshold. That's commonly referred to as a tax trigger, and we saw over 10 states enact something like that in recent years. Next slide, please. But if you want to get a better picture of effective tax burdens, though, you need to take the income tax brackets into account. For example, Massachusetts has a relatively low marginal rate of 5%, but it is a flat rate that applies across all income levels. Georgia has 6 rates levied at different income levels, and its top rate is of 5.5% is applied to all income over 10,000. And then you look at New Jersey, which has a much higher marginal rate of 10.75%, but it applies only to income over $1 million. So if you're making $75,000 or less, the rates are actually lower in New Jersey. Next slide, please. For both personal and corporate income taxes, an important thing to note is that most states tether themselves to the federal code by using federal definitions for income as the starting point for state tax calculations. So this means that changes to the federal code are going to be significant for states too, and revenues will go up or down depending on what is deductible and what's not. The extent to which states conform to the federal tax code has been a recent focus lately. We had the Tax Cuts and Jobs Act a few years ago that required a great deal of state attention and continues to do so. Then the Federal CARES Act included a number of changes to the tax code to provide relief to businesses, which many states still have not responded to. So whether it conformed to those, as well as federal treatment of PPP loans in particular, is another issue that is building steam in several states. And then to segue into the corporate income tax, final important thing to note about personal income tax is that 90% of all American businesses are S corporations that file their tax through the individual income tax code. It's very much a business tax. So as changes are made to the corporate income side, it's worth considering how the personal income tax on pass-throughs compares in terms of parity. There's also been a recent rise in new entity level taxes for S corporations ever since the federal government capped the deduction for state and local income, sales, and property taxes at the end of 2017. 7 states have now adopted entity level taxes, which are fully deductible at the federal level, and they've created offsetting income tax credits for those taxpayers as a way to circumnavigate that cap on federal SALT deduction. Next slide, please. Oh, so moving on to the corporate income tax, here again is a chart of the highest and lowest marginal rates. Unlike the personal income tax, the majority of states impose the corporate income tax at a flat rate rather than using a graduated structure. This is because the size of a corporation isn't necessarily related to the income of the owner. So there's no relevant ability to pay concept like there is with the income tax, personal income tax. The states with the flat tax rates range from a low of 3% in North Carolina to 9.9% in Virginia. States with graduated tax rates, the range is a low of 1% on taxable income below $3,000 in Arkansas to 9.8% on income above $250,000 in Iowa. There are also several states that do not have a corporate income tax, but tax businesses in the form of a gross receipts tax. A handful of states do this: Nevada, Texas, Ohio. Delaware has both a corporate income tax and a gross receipts tax. These taxes work by taxing all business transactions with few allowable deductions. So it's not really tied to profitability. Tax rates on these transactions are all low, usually a few tenths of a percent. Some compare the tax to a sales tax, but the sales tax is assessed only on final consumer purchases of product, while the gross receipts tax is assessed at every stage of production. Next slide, please. Again, the corporate income tax is only around 5% of tax collections, but it used to represent a much larger share. It was about 9.5% of collections in the early 1980s. This gradual erosion has several causes. Some of the most commonly cited ones are an increase in tax planning opportunities that smart accountants employ that they can take advantage of, tax incentives, the increasing popularity of S corporations and businesses filing through the personal income tax code, which until recently had more favorable tax treatment at the federal level, and then changes in the apportionment formulas that states use to determine corporate tax liability. Increasingly, they've been altered in ways that benefit larger corporations that have a lot of payroll and property in state, and a lot of sales made out of state. Some states have taken steps to revamp various aspects of their corporate income tax to raise revenue, such as increasing scrutiny and evaluations of tax incentives, or requiring certain related companies to file one return as if they were a single entity in the form of combined reporting to prevent artificial intercompany income shifting. Next slide, please. Moving on to the sales tax. Again, sales tax, second largest state tax category, 45 states impose one. A number of states allow local governments to collect sales tax in addition to the state levy. Alaska allows local sales taxes even though there is no state sales tax. This chart here shows the current highest and lowest sales tax rates. It's commonly criticized for its regressivity. People with lower incomes will have a higher percentage of it taken by the tax than the wealthy, but it is a relatively easy tax to collect, has high compliance rates, and as I mentioned earlier, it's a little less prone to fluctuation, so a bit more reliable. Sales tax is levied on consumers at the point of retail purchase, and it's generally intended to be a tax on consumption, but that's really not the case for most American sales taxes. About 40% of total state sales tax revenue comes from taxes on business inputs. That's materials used in the manufacturing process, items like napkins or utensils that are provided free of charge, office computers. Taxing these items is considered a tax on production rather than consumption, which is generally frowned upon in tax policy circles. So the existing tax base is far from theoretical ideal, but a longstanding challenge facing the sales tax is that a growing number of consumer purchases are not subject to sales tax in many states. And the result is a narrowing of sales tax bases. And that means that statutory rates have gone up as a result. The median state sales tax rate was 3.25% in 1970, 4% in 1980, 5% in 1990 through 2000, and 6% today. Part of this is due to the fact that the existing tax base has been carved up a bit. Most states now exempt food, things like prescription medication from tax, a way to reduce regressivity. Beyond the specific exemptions, at least 16 states plan to hold a sales tax holiday in 2021, or a temporary period where certain items are able to be sold tax-free. Usually this is done with the goal of boosting economic activity and providing temporary tax relief, but experts question whether the sales tax holidays effectively accomplish those goals, although they can cost states tens of millions of dollars. Next slide, please. The most important contributor to the eroding sales tax base, though, has been the shift in the American economy towards the service industry. Most states adopted their sales taxes between 1930 and 1960 and generally chose to apply the tax only to sales of tangible personal property. This wasn't a significant exemption for services at the time. Goods represented more than 60% of total personal consumption, but that number has flipped since the sales tax was created, and service transactions now make up about 2/3 of personal consumption. Many of these purchases are exempt from tax. This graphic from the Federal Reserve shows personal consumption of goods relative to services over time, and you can see that that difference has just been growing between tangible goods and services. We now spend twice as much on services. So, and furthermore, there are also many taxable tangible products that are increasingly being replaced by intangible digital products. Instead of buying a book at the bookstore, people are downloading books on their phone. This is not a new development, but only half the states tax digital products or streaming services like Netflix, as I mentioned. So modernizing sales tax systems and expanding the sales tax base will continue to be a focus. Next slide, please. And on that front, sales tax modernization has been one of the most prevalent tax issues. And leading up to the pandemic, the most significant tax trend by far was the implementation of laws to require internet retailers to collect sales and use taxes. All of the states that have sales taxes, except for Florida, have passed laws to do so in the 2.5 years since the Supreme Court paved the way for it. All of the sales tax states, except Florida, Missouri, and Kansas, have also passed laws requiring marketplace facilitators, entities that facilitate sales for third-party sellers, your Amazons and eBays, require them to collect sales taxes on those third-party sales as well. So this has been a revenue boost of tens to hundreds of millions of dollars in most cases. And now that states have these laws in place, a growing number of them, next slide, please, are looking to require marketplace facilitators to collect other kinds of taxes that are applied on certain transactions. You can see here that in 2020, car sharing, ride sharing, local lodging taxes were targeted for collection by online platforms. Next slide, please. This might be a good point to segue into the selective sales tax category, or excise taxes. This is where many of the most trendy tax topics are. The sharing economy has introduced a lot of fast-growing businesses that are upending established industries and presenting states with new regulatory and tax questions. Shifting viewpoints and hopes of generating new revenue has also led many states to legalize and tax things like sports betting and marijuana. The rising popularity of vaping has made e-cigarette taxation a prevalent issue. Politically, it's more palatable to raise sin taxes or tourism taxes than broad-based taxes, so we often see states try to plug budget holes with these revenue sources before looking at increases elsewhere. Although these tax categories, it should be noted, rarely provide enough revenue to fix structural imbalances. But you can see coming up here that excise taxes were popular in 2020, and that will probably continue in 2021. Next slide, please. So I think many are anticipating that 2021 will be a relatively busy year on the revenue front, although additional federal aid could slow that down. That's partly because states are more likely to make tax changes that will result in an increase in revenue during and after recessions, and they're more likely to enact tax changes that will result in a decrease in revenue when times are better. A few states in 2020, such as California, New Jersey, and Tennessee, enacted some significant revenue changes, but most states took few or no tax actions and waited to get a better sense of their short and long-term revenue systems or situations, and chose to balance their budgets through cuts, tapping reserve funds, or borrowing, and put the revenue decisions on hold. So this slide shows the major trends of 2020. The filing extensions that were granted for certain personal income tax filers were noted as one of the biggest issues in surveys that we've sent to states. Conformity with the Federal CARES Act, that was far and away the second most cited issue in our surveys to states. And then excise taxes occupied a lot of focus. Next slide, please. It's still early in most state legislative sessions, but here are some proposals that stand out. Several states have proposed measures to impose a new tax on digital advertising, targeting the social media and tech companies, and this has generated a lot of press. There's some controversy around whether these could survive a constitutional challenge, but they could raise a lot of money on a sector of the economy that has been growing rapidly. A measure that was vetoed in Maryland might be overridden by the legislature. I think the Senate is voting on it today, and New York and Connecticut are considering similar measures as well. Several states have imposed personal income tax increases, usually on higher earners. A measure in Alaska would create an income tax. A few new types of taxes have been proposed on wealth or capital gains as well. And then there's also several bills that have been proposed to eliminate or reduce corporate or personal income taxes. Another 8 states have proposed increasing earned income or child tax credits, or increasing the standard deduction, or otherwise providing relief to taxpayers through the income tax code beyond cutting rates. And then several states have also introduced legislation intended to limit property tax increases or increase homestead exemptions. And those include Indiana, Kentucky, Montana, Nebraska, and Texas. Again, we've seen the 3 states that do not have marketplace facilitator laws on the books, proposed measures on that front, several more states looking at taxing digital goods or services, and then look at those excise taxes go. Marijuana legalization and taxation has been proposed in at least 11 states. Sports betting legalization is all over the map. At least 18 states are looking to legalize or expand operations. And then at least 19 states looking at tobacco or vaping tax increases. So I'll end it here, but happy to discuss any of what I've covered further if you have questions, or feel free to reach out to me afterwards.
Okay, I think early on there was a question that I think is for Erlinda, and they ask that somebody is asking, how worried should we be about the federal debt? That's for you, Erlinda.
Yes.
I'm
Yeah, so obviously the notion of the debt has gotten a lot of press lately with and it's expected, especially since we've been putting trillions of dollars into the economy to help ease the effects of the pandemic. So right now we're not as concerned about the debt because interest rates are so low, but that will obviously change over time, and especially now since the numbers regarding our debt are pretty staggering. So right now for 2021, the CBO reported that the debt's supposed to be about 102% of GDP, which is pretty mind-blowing, and then 107% by 2031, which are clearly records. And these are obviously considerations too with negotiations happening right now on the Hill regarding President Biden's $1.9 trillion proposal, because this is not actually factoring in his proposal. So it's definitely an issue we need to be concerned about. But again, the role of the federal government has been, and rightly so, has been to stimulate through these different measures of the economy and to help citizens with direct payments and businesses as well. So yeah, so it's sort of a loaded question, because some people will tell you it matters a lot and others will tell you that it doesn't. But it is definitely a consideration, especially as we are getting into really high numbers with respect to percentages. But it will become an issue, I think, once we get through this pandemic and once the economy starts to recover, there will be much more focused discussions about how we address the debt going forward.
Great, thank you, Erlinda. Okay, then here's one that I think is for either Jackson or Linda. It's about combined reporting. Mentioned some states are considering combined reporting. How many states already do this and which are considering it now?
I don't have a list on me, but I think it's about half that have combined reporting. And the only state I'm aware of that has proposed something on it in 2021 is Virginia. But it's possible that I'm missing some. Virginia is the only one in 2021 that I'm aware of.
Okay, great, thank you. So another question, this one is for Jackson regarding unemployment insurance taxes. Have states taken any action there given so many new jobless claims?
So the unemployment side of things is something our employment, labor, and retirement program is more closely monitoring, but I know we have seen a handful of states take action to freeze UI taxes in place and prevent them from increasing. Idaho, for example, is on the verge of having to increase its unemployment tax until the governor transferred $200 million in CARES Act dollars to keep it solvent. I think at least more than half the states are already borrowing from the federal government to sustain their unemployment insurance funds, and that money will need to be paid back at some point. So I think increasingly we'll see states take steps to try to avoid significant payroll hikes, but some may be inevitable at some point.
Okay, great. So one more, what are the trends in tax incentives, especially now that states are looking to assist businesses and help them recover?
It's an interesting moment for tax incentives. Every state uses them to try to encourage businesses to relocate to the state or expand existing operations and investments. They're estimated to cost states tens of billions of dollars annually. The problem leading up to the pandemic, the problem was that in addition to incentives violating a lot of basic principles of good tax policies, most states have, until recently, not had a very good understanding of whether those investments are actually effective at encouraging development. But since the recession, we saw a majority of states over 30 pass laws to kind of require regular evaluation of incentives. And there's also been a fair amount of recent research that has cast some doubt on the effectiveness of tax credits as currently constructed. And then last year, we saw at least 11 states propose measures that would require the state to join a multi-state compact where states would agree not to try to poach businesses from each other in other member states. So that's a long way of saying that there's been a lot more scrutiny of these programs recently, and for states that need revenue, underperforming incentive programs might be considered for the chopping block. But at the same time, states and localities are really pressed to try to help businesses financially. And historically, that kind of political pressure usually leads to incentives winning out. States like California, New Jersey, Nebraska have all approved pretty big incentive packages in recent months. So there may be divergent approaches in the states. Either way, I think it's a good opportunity to reform incentives and maybe make their availability more equitable and better targeted towards the businesses that have borne the worst impacts of the pandemic. At the moment, incentives more often go to out-of-state businesses, but public finance experts say they're more productive if they go to locally owned companies. Cash incentives are usually the majority of incentives, but research shows that customized job training services are a bit more effective job creation tools. Most incentives don't target distressed communities, but those tend to increase the multiplier effect. So yeah, we'll see where states go.
Okay, thank you. And I'll encourage, if anyone else has any questions, go ahead and write them in the Q&A. But I just have one more, and that's just sort of to get your thoughts. What are you hearing about and this is for Jackson, what are you hearing about the issue of income tax across states as people work remotely?
So yeah, well, one of the major tax-related impacts of the coronavirus has stemmed from the shift of workers moving to remote situations. And nexus is a big term in the tax world. It's the point at which a person or a business's activities or income in a state are substantial enough to allow a state to impose tax on it. And so workers that that once traveled into one state but who have been working from home for most of 2020, you think about like the tri-state area specifically, they're suddenly no longer meeting those physical nexus requirements for personal or corporate income tax that the state would otherwise. And so, this one state would have otherwise received that income, and now it's reverting to the home state. So states there is currently a case, New Hampshire is suing Massachusetts for imposing an income tax on remote workers, and other states have joined that case. So we may see the Supreme Court take that up, and that could potentially mean a uniform national standard for non-resident income tax nexus requirements.
Okay, great, thank you. So I haven't seen any more questions come across. So unless someone has one in the next 10 seconds, I'm going to go ahead and thank our speakers. Thank you, Erlinda and Erica and Jackson, for a very informative presentation. And I want to thank everyone out there in the audience for your time and attention and for joining us. And I hope you enjoy the rest of the state policy series, whatever other sessions you decide to join. And with that, thank you all.